This is WCI Real Estate Masterclass number 2, calculations every real estate investor must know. Welcome back. Today we're going to talk about 5 calculations. The first one is a capitalization rate. The second one is a net operating income. Third one is the 45% rule. Then we're going to talk about the cash-on-cash return and a concept known as the break-even ratio. Now, we go over all kinds of additional calculations and terms in the No Hype Real Estate Investing course. So if there's not enough in here for you, you can always take the course. You can get more information at whitecoatinvestor.com/no-hype. So why do these calculations matter at all? Well, real estate investing has a vocabulary that's all its own. And just like it took you a while to learn how to speak medicine and a while to learn how to speak investing in general, it's going to take a little while to learn how to speak real estate. And until you understand these terms and these calculations and how to do them, it's going to be really hard to relate to anybody, whether you're in direct real estate investing, whether you're in passive real estate investing. You got to understand these terms. They also help you to know where you stand with a given investment at any given time, and they allow you to compare one potential investment to another. The good news is they really only require 4th grade math. Anything that requires anything more than that can be done easily with a financial calculator or a spreadsheet. But for the most part, we're only talking about addition, subtraction, multiplication, and division. All right, our first calculation we're going to talk about today is the capitalization rate or the cap rate. And if you've heard a cap 6 property or the cap rate is 6 or 8, then this is what we're talking about. Okay, in this calculation, the numerator is the net income from the property, aka the net operating income. It's all the expenses or all the income from it minus all the expenses except debt service. So it's basically how much would the property make if you had paid cash for it. So if it was a $100,000 property, right, and you paid cash for it, and it was paying out, $6,000 or $7,000 a year, that would be a cap rate 6 or a cap rate 7 property. Okay, so the numerator is the amount of income you're getting from it. The denominator is the value of the property. To be technically accurate, the denominator is really the total paid to acquire the property and put it in service. For example, if we're talking about like a short-term rental and you bought it for $400,000, but then you put another $50,000 into it in furniture and furnishings and TVs and that sort of stuff, the actual denominator would be $450,000, even though it's only a $400,000 property. All right. So as an example, right, the cap rate equals the net operating income or NOI over the value of the property. A property that provides gross rent of $11,000 per year and has a net operating income of $6,000 per year. If it costs $100,000 to purchase, that is a 6% or a cap rate 6 property. So a really low capitalization rate would be something like 2 to 4%. A really high one would be something more like 10 to 15%. Low cap rate properties may not be bad investments, and high cap rate properties may not be good ones. But as a general rule, a high cap rate property is more likely to provide more of your return as income. And of course, all else being equal, a higher cap rate is a good thing, but all else is never equal. So what do you use a capitalization rate for? Well, it gives you an idea of the cash flow you could get when you buy a property. And once you know the NOI of an individual property and the general cap rate in the area, it allows you to then reverse engineer the equation and estimate the value of a property. Likewise, if you know the value of a property and you know the general cap rate in the area, you can estimate its NOI. One thing you do need to be careful of, especially in the passive real estate investing space, is to beware of operators or general partners who in their pro formas are projecting a lower cap rate at the time of sale than at the time of purchase. Because obviously, if you can buy something at a higher cap rate and then sell it at a lower cap rate, that means it's appreciated in value significantly. And it's one way they can juice their projected returns by changing the cap rate. In fact, I like to see operators actually projecting a higher cap rate at sale than at purchase. All right, let's talk about our second calculation today. This one I've mentioned briefly. It is net operating income. Now, if we start at the top, we start with gross scheduled income. Gross scheduled or gross potential income is all the income that you could potentially receive from a property. The gross operating income is all the income you actually received from a property. And your net operating income, this NOI, this figure that gets thrown around all the time in real estate, is the gross operating income minus all of the non-mortgage expenses. So what are non-mortgage expenses? Well, they're things like property taxes, management fees, maintenance, insurance, utilities, any other costs except mortgage principal and interest. So let's use an example. Let's say you have a $400,000 property. The rent is $2,000 per month or $24,000 per year. This is gross scheduled income. But this year, the property sat vacant for 1 month and you gave a 50% discount on rent for another month. So your gross operating income was actually $21,000 per year, not $24,000 per year. The management fees were $1,500. The insurance was $800. The taxes were $3,000. You spent $400 on snow removal and $600 on lawn care. Other repair and maintenance costs were $600, and you spent $120 on utilities. So your net operating income is $13,980. You simply subtract all of those expenses from the gross operating income. Very easy. Simple subtraction. You learned about it in second or third grade. But the net operating income is an extremely important calculation. Every real estate investor should understand and calculate periodically. You can't calculate your taxes due or your cash flow without first calculating your net operating income. All right, let's move on to our third calculation today. This one is something I call the expense ratio, or sometimes referred to as the 45% rule. Okay, don't confuse this with a mutual fund expense ratio. With a mutual fund, you want to see an expense ratio under 0.5%, or ideally less than 0.1%. And that's just not going to happen with real estate. Okay, you're running an actual business here, not an index fund. Okay, the expense ratio is simply the non-mortgage expenses divided by the gross operating income. Okay, so think about that. The non-mortgage expenses divided by the gross operating income. So a typical expense ratio is in the 0.4 to 0.5 range, thus the 45% rule. That basically 45% of the rent you take in from a property is going to go toward paying your non-mortgage expenses. So the expense ratio is really a measure of the efficiency of management. And lower expense ratio almost always is better. It shows that it's a more efficient investment. You get to keep more of the income that you're generating from it. But if it's too high, that indicates inefficiency. It means that maybe you have too many expenses, or perhaps you're not charging enough for rents. So when you see that, your expense ratio is too high, it's 50%, 55%, you ought to ask yourself, can I raise rents? Or can I cut expenses? What can I do to get this back into the 0.4 to 0.5 range? However, if your expense ratio is too low, it can indicate some problems. It can indicate that perhaps you're inadequately insured, or perhaps inadequate maintenance is being done on the property, and you're going to end up with a bunch of deferred maintenance problems because you're not spending enough on the property. So while you might be thrilled to see that you've got your expense ratio down to 0.35 or 0.3, you got to ask yourself, should it be this low? And maybe it shouldn't. But the 45% rule is a quick and easy way to estimate the net operating income if you know the rent being charged for a property. If you know a property is charging rent of $1,000 a month, you can say that, well, shoot, the net operating income is probably going to be about $550 per month because there's going to be an expense ratio there. All right. The next calculation I'd like to talk about is the cash on cash return. And in real estate investing, we typically talk about 3 different types of return. The first is my favorite. It's probably the most accurate type of return. It's called the IRR, or internal rate of return. It is a dollar-weighted rate of return. And you can use it to compare one type of investment to another type. You can compare the return from your real estate investment to the return from your mutual funds, for instance. It's very handy. You typically calculate it with a spreadsheet or a financial calculator. The second type of return is what's called the equity multiple. And I don't know why people like this so much, but a lot of people like it. You see it used a lot in real estate. You see it used a lot in the angel investing space. But this equity multiple tells you what ratio of money you got back for what you invested. So if you invested $100,000 and over the time you own the investment and you got back $150,000, that's a 1.5 equity multiple, 1.5x, because you got back 1.5 times what you invested. And typically in real estate deals, that's often 1.5 or 2. But the problem with the equity multiple, it doesn't tell you anything about its IRR unless you know how long you owned it. For example, if you only own a property for 1 year, a 1.5x equity multiple is awesome. If you own that thing for 20 years, it's terrible. So you got to keep in mind, it doesn't tell you anything unless you know how long you held the property for. A cash-on-cash return is particularly useful for income-focused investors, and that's why it's worth knowing what it is and how to calculate it. It's basically the amount of cash you receive divided by the amount of the original investment. And that's important to understand that it's the original investment, not the current value of the property. So you take your gross operating income, you subtract your non-mortgage expenses, then you subtract your mortgage principal and interest, and that gives you your cash flow from the property. Then you divide that cash flow by the amount that you invested. So let's look at that property we talked about earlier. This is a $400,000 property. It's got a gross scheduled income of $24,000. It's got a net operating income of $13,980. Let's say its debt service is $12,000. So your cash flow is a positive $1,980. If you put down $80,000 toward this property, that's a cash-on-cash return of $1,980 divided by $80,000. And that comes out to 2.5%. Note that a cash-on-cash return is not your total return. It doesn't include appreciation. It doesn't include amortization of the mortgage. It doesn't include any tax benefits from owning the property. It's highly dependent on the amount of leverage. Okay? The other thing to understand about it is that it means less and less as time goes on, right? A 25% cash-on-cash return sounds awesome, but not if it's in year 15 of the investment, right? In year 1 or 2, that'd be incredible. In year 15, not impressed, right? Everything is appreciated by that time. And with inflation, you would expect the income you're getting from this property to be significantly higher, but you're still dividing it by the amount of your initial investment. So it really only means much in the beginning of investment. For a long-term rental, 6 to 10% can be an excellent cash-on-cash return. For a short-term rental, you typically expect it to be higher, and you can even get cash-on-cash returns of up to 20% with a short-term rental. All right, let's talk about a break-even ratio. You may not actually care about your break-even ratio, but I can assure you that your lender will. This is the ratio of your expenses, including debt service, to your gross operating income. So if our example property has operating expenses of $7,020 and the mortgage costs are $12,000 per year, the total expenses are $19,020 per year. The gross operating income is $21,000. So the break-even ratio is calculated as $19,020 divided by $21,000 gives you a ratio of 91%. Now, what does that mean? Well, lenders like to see the break-even ratio at several percentage points less than the average occupancy ratio in the area. So if your occupancy ratio in this apartment building is 95%, you're probably fine. If the occupancy ratio is 88%, the lender may want you to make a bigger down payment. They may not even want to lend you at all. They want to see a better break-even ratio. So it's something they use to determine whether they want to lend to you and how much they want to lend to you. Okay, so let's put all these calculations together. What have we learned about this example property we've been talking about by running the numbers on it? Well, what is the cap rate? Well, the NOI divided by the value of the property, right? So 13,980 divided by 400,000 tells us the cap rate is 3.5%, which is relatively low as cap rates go. What's the NOI? Well, that's 13,980. What's the expense ratio? That's 7,020 divided by 21,000 is 33%. So that's a little bit low. So that suggests that the property is either run very efficiently or that it's underinsured or maybe that inadequate maintenance is being done. What's the cash-on-cash return? About 2.5%, which I'll tell you, not a lot of people are going to get super excited about that. What's the break-even ratio? On this property, it's 91%. So the debt service is only $12,000 a year on a mortgage of $320,000. That suggests a loan interest rate of only 0.78%. If this mortgage were actually 6%, your debt service would be $23,247, and your cash flow would be quite negative. So at this price, you can pretty much know that this is not a great investment. And the way you learned that was by running the numbers. So despite it being a cash flow positive investment, it's probably not a great investment. I'd also like to know where you got that mortgage from. All right. So the difference between a home buyer and a real estate investor is the ability to do calculations like these. When you go to buy a house, you're really only asking yourself two questions. Number one, do I like the house? Number two, can I make the payments? But it's very different when you're investing in real estate. You've got to look at the numbers because there are other options to invest in. You can go invest in publicly traded real estate. You can go invest in index funds, right? If you're not going to get a solid return from a real estate, why would you go through the hassle of investing in it? It's also important that you can speak real estate, because if you can't speak real estate and you can't do the basic real estate calculations, you're not going to be very successful as a real estate investor. So stick to something where you need very little expertise, like a REIT index fund, or get educated. All right, in our next masterclass, the third session of this three-part series, we're going to talk all about the tax benefits of real estate. So make sure you tune in for that.